So hello everybody, I'm back again. I want to try to finish up the slides for chapter 11. I want to go back, I'll go back one slide, and we went over this example here, okay, about if something is sold for higher than its book value, you have to pay taxes on it, and all that. And there's a nice little graph here, okay. Look at this graph. You'll notice here, if something is sold for $110,000, and if this was the initial purchase price, $100,000, everyone see that? Basically, you made $10,000 on it. That $10,000 is reflected here, right? That's called a capital gain. Okay, so basically, you've got a capital gain here. Everyone see that right here? And basically, you got to pay tax on $10,000 at the current capital gain rate. All right, now, if you initial purchase price was $100,000 and you sold it for $110,000, you've got a gain of $52,000 in recaptured depreciation. Okay, so you can see the total gain is $62,000, but $10,000 was that extra you got, which is the capital gain, and then the other 52, right, is basically recaptured depreciation. You can't have your cake and eat it too. This is really what it's worth. It's worth this right here, right? So they have different scenarios. If you sell it for 48, which is its book value, you have no gain or loss, so you don't have to pay taxes on that. If you sell it for 70, you've got a gain of $22,000 above its book value, and you pay taxes on that. But there's no capital gains on that. So this is an important slide that gives you the taxable income from sales of assets, if they're above their book value. All right, net working capital and is the amount by which a firm's current assets exceeds its current liability. And the change in net working capital is the change in current assets minus the change in the current liabilities. You notice that? Difference between the change in current assets and the change in current liabilities. And this is what we looked at when we looked at the initial investment. And this is in your text. You should really read up on this section here. All right, so here's how you, here's a simple example of calculating net working capital. The change in the cash balance is 4,000, and the change in the accounts receivable is 10. The change in the inventories is 8,000. So your current assets, right, is the change in the current assets is 22,000, and over here you're changing your current liabilities is 9,000. So if I subtract the two, as I stated before, you're changing your net working capital will be $13,000. And you need that for the initial investment. All right, so let's go through these numbers here. Okay, so Powell Corporation is trying to determine the initial investment required to replace an old machine with a new one. The proposed machine's purchase price is $380,000, and you notice you're going to have to add $20,000 to install the machine. That brings you up to $400,000. We're going to depreciate that under makers using a 5-year recovery period. The present machine was purchased 3 years ago at a cost of $240,000 and was being depreciated under makers using a 5-year recovery period. The firm has found a buyer willing to pay $280,000 for the present machine and to remove it at the buyer's expense. The firm expects that a $35,000 increase in current assets and an $18,000 increase in current liabilities will accompany the replacement. So we can get the changing, the net working capital by simply right away subtracting the 18 from the 35, and our change in net working capital will be 17,000. The firm pays taxes at a rate of 40%. All right, so here is the way we do this initial investment. The new machine installed is going to be $400,000. Everybody remember that? It's going to be 380 plus 20. Okay, so that's $400,000 minus the after-tax proceeds of selling the old machine. So you're going to sell the old machine for $280,000, and here's the tax you're going to pay on the old machine. Notice you're selling this for more than the $240,000, so there's a capital gain involved that you're going to have to pay tax on. So this is your after-tax proceeds, right, from the sale of the old machine after you pay taxes on that. Again, here's your change in net working capital I previously talked about. So if we have 400,000 minus 195,000 plus 17,000, your initial investment will be $221,160, okay? Because you're going to bring home 195,840 from selling the old machine, okay? But you have a change in net working capital of 17,000. So it's this 400,000 minus this here plus this guy right here. All right, now we got to get the operating cash flows. Okay, so here's the operating cash flows that from, now we do the flows, and this is with the proposed machine. This is all given to you. And here's with the present machine. So here's the revenues from the new machine, and here's the expenses from the new machine, and here are the revenues from the old machine and the expenses from the old machine. Again, this is all given. All right, now we got to look at the depreciation on the proposed and the present machine. All right, so here's the depreciation on the proposed machine. This is what it's going to cost, and here's the maker's depreciation table. Look in your book at chapter 4, table 4.2. Okay, and we're just multiplying these two columns together to get, as you can see, to get to depreciation. And after 5.5 years, it is fully depreciated. All right, so this is the proposed machine. And here's the present machine being depreciated. Okay, so it's there's 2.5 years here of depreciation, and after the third year here, year 6 depreciation, it's fully depreciated. So this is the book value. All right, so here's the income statement that we're going to use. Here's the revenues, here's the expenses, and that gives you the earnings after you subtract it. We then subtract the depreciation, and we get what's known as EBIT, earnings before interest and taxes. Then we subtract the taxes, and then we add the depreciation back on. And we end up with basically the operating cash flows for this example. And here we are doing that from each year. So here's the revenue from that was given. Here's the expenses. And we start doing a subtraction here. Here's the depreciation we calculated before. So this is the proposed machine. All right, everyone's clear, right? The new machine. And we just go through all the math here. You notice that the depreciation gets put back on after it's a dual sword. After the depreciation is subtracted to lower your tax rate, we add it back on because it's a non-cash charge. Here's the present machine. Okay, so here's the depreciation for the last 3 years. So here's the cash flows from the proposed machine, which we previously saw, and here's the cash flows from the present machine. And the difference is basically showing you that it makes sense to buy the new machine, the proposed machine, because you're going to have some larger cash flows. All right, this here is simply the difference between column 1 and column 2. All right, so the terminal cash flow is the cash flow from giving up on the project or selling the equipment. And in this case, technically you put the net working capital, it reverts back on. And that'll be a cash, all right, inflow. So here is the from after-tax proceeds from sale of the new asset minus the after-tax proceeds from sale of the old asset. And here's, again, your change in net working capital, which gets put back on. And we go through this math here. Here's the 17,000 net working capital we put back on. And here's the terminal cash flow from sale of the proposed machine and the sale of the present machine. They changed the numbers here a little bit. All right, so here we see all the examples we did are shown in this one graph. This is the initial investment right here, and here are the cash flows, and here is the terminal cash flow. Okay? And there's a personal finance example. You can go through this yourself and understand this from a personal finance level. Okay, so that's about it. And in the next day or so, I'll do chapter 12. All right, I hope everyone's clear. If not, always email me. You always have that option. Have a good evening, everybody.